we are going to be investing our own money.
Investing can be seen as inaccessible or complicated or difficult to understand or off-putting.
You are putting your real life money at stake. You are doing something. You earn that money, and to say, okay, I'm going to take a risk now and see what happens.
The world's changing rapidly, so how can I best position myself and my family in that?
Investing can be quite lonely if you're just doing it on your own.
Yeah,
especially if you don't have mates who are also doing it with you and talking about it.
Quantitative techniques are something that is pretty much eluded the entire industry. Skills is something really only reserved for the institutional investors and big, large investment houses.
We don't have that culture here in the UK, so we want to open that up a little bit.
AI will, I should think, drive profits higher for a lot of companies if it can bring about a lot of change. If it does change the workforce significantly.
The hype train might come off. I think that might have an impact. I've mentioned before about that kind of overvaluation, the circularity of it. It just makes me nervous.
I picked industrials as well because I know the world needs more diggers. But I think we're going to have to find you we're going to have to find you the defence sector as well. Why is that, Chris? You're doing a sort of a centre-left pitch for the defence industry.
Well, I
don't want to call it a contest because it's just two guys investing, not turning it into a competition.
Hey, this is the great thing about investing. Everyone can have an opinion and both sides can be kind of right or wrong at the same time.
Hello everybody and welcome to our brand new series about investing called Investing Stakes, brought to you by Mouthy Money and in partnership with Stratify. I am joined as ever I usually am on the normal podcast by my good co-host Chris Tuite, who is Head of Consumer Finance at Communications Consultancy at MRM. Chris, hello and welcome to this brand new series.
Hi Ed, how you doing? Delighted to be here. Really looking forward to this.
Likewise, really happy to be launching something brand new. So what are we doing? Let's get right into it. We are launching a brand new series in partnership with an investing app called Stratify. Now we're joined by somebody from Stratify who I will introduce very shortly. But basically what we're going to be doing on this new series, which is going to be taking place monthly, is we are going to be investing our own money. Chris Tuite and I are going to be investing our own money.
Skin in the game, Ed. Skin in the game.
Skin in the game.
Quite substantial skin. Yeah.
And that is why we've decided to call the new series Investing Stakes, because we are taking a stake and we are seeing what is at stake. I know, Chris, you love a pun. But yeah, this is it. We are going to be investing our own money on the Stratify platform. We are going to be looking at how Stratify allows for those investments, what the platform lets you do. And we're going to be talking through our decisions, the ups and downs of the markets and all that sort of stuff. So why are we doing that, Chris? Why are we investing our own money? Why does it matter that we have our own stake in this process instead of just talking in general terms about it?
I think it's really important to have a stake in what we're trying to achieve. If it's real money, you have to make real decisions with real consequences. And that's why we've decided to do it that way, I think, Ed, because it does focus the mind. It makes you think a little bit more about what it is you want to achieve. You can't just be flippant. You can't just kind of take a stance and, cross your fingers and go, oh, well, it wasn't my money to kind of play with. Like it's our own cash. And therefore there's, I don't know about you, but in terms of our financial situation as a family, there is a desire to make sure that grows. While it's £500 that we put in. So while it's not going to kind of break the bank, I do want to see returns on that. I do want to see us kind of do well. And also, very importantly, investing your own money means that you focus more on what's going on. And I want to learn from this process. And I think that's one of the things that our audience have stressed to us in the past as well with some of the emails and the questions that we get in, which is investing can be seen as inaccessible or complicated or difficult to understand or off-putting. And so if we've got our own money, if we partner with the guys at Stratify who are going to help us to do this, and they've got really great ways to help us do this in a kind of least painful way possible. And Chris L will talk more about that shortly. But then we're able to kind of learn as we go along. That's the thing I'm most excited about, is over the course of the next few months, working with Chris L and yourself, Ed, to learn more about what I'm doing and why I'm doing it. Because for now, I've taken a couple of positions, but it's been broadly sort of passive tracker funds, as we've talked about before. And while there's nothing wrong with that, I hasten to add, I think I'd like to go a bit deeper and understand what's inside those wrappers. What are they doing? Why are they doing it? And the world's changing rapidly. So how can I best position myself and my family in that? And I think this will go a long way to kind of helping me learn about that. So does that answer the question, Ed? It's a bit rambly.
No, it does. I like it. I mean, so you've touched on a few things that I think quite interesting. The first is that, and you mentioned index funds. Now, Stratify does things slightly differently, and Chris L is going to I'm going to introduce him properly in a minute. Don't worry. He's waiting very patiently. He's going to explain to us some of the sort of the methodology behind what Stratify offers to its customers. It is a slightly different than your typical investment platform, ETFs, index funds, that sort of thing. And we are going to talk through that because it's quite interesting. Then I think for myself, it's investing can be quite emotional. It's something that's difficult to just strip out the emotion from, because it's something that, you are putting your real life money at stake. You are doing something, you earn that money, and to say, okay, I'm going to take a risk now and see what happens. It quite requires an emotional engagement that I think can be positive, but can also be negative. The other thing, and I talked about this in a recent video when we were kind of launching and talking about the partnership, investing can be quite lonely if you're just doing it on your own.
Yeah,
especially if you don't have mates who are also doing it with you and talking about it. And it's that almost bringing that, okay, well, we're in this together, we're all doing it. You don't need to be on your own in a silo. And Brits are sort of famously bad at talking about this stuff. And you hear those sort of stereotypes of New York taxi cab drivers who talk to you about their investments and that thing. We don't have that culture here in the UK. So we want to open that up a little bit. We want to be able to talk about it. We want people who are watching these videos or listening, if you're listening on podcast, to tell us their thoughts as well. What are you doing with your investment? What are your plans? What is your long-term goal for that investment? I think those are all really interesting, important things to talk about. And part of this series is, it's us being able to open that discussion up so that we can have that conversation. Even just having that conversation, I think, is so important.
Yeah,
so
completely.
With that, I'm going to introduce our guest, who's waited very patiently. So his name is Chris Ling. He is the Chief Investment Officer at Stratify. Chris, hello and welcome to Investing Stakes.
Hi, Ed. Yeah, thanks for having me. I'm really excited to launch this podcast series with you.
Yeah, it's a pleasure to have you on. Now, Chris...
Reassuring as well, by the way, not just a pleasure.
Yeah.
Somebody knows what they're doing. Like, fantastic.
So... for those following along, I do now have a Chris double threat on the podcast. I have two Chris's. So for the purposes, I'm going to refer to my regular co-host Chris Tuite as Chris T, and Chris Ling is going to be Chris L, just to ensure the questions are being asked in the right directions. Now, Chris L, just tell us a bit about yourself. Give us a bit about your background, what brought you to ultimately to Stratify and the podcast.
Yeah, so, I've been in the investment world pretty much since leaving university, and that was some 22 odd years ago. So I've had my time in and around the markets in various roles. I've been a global equity portfolio manager with AllianceBernstein, which is a large US active asset manager, and more latterly I was the head of investment at Fowler Drew, and currently at Peregrine Black with Stratify as their chief investment officer, as of this year, in fact. So my Stratify career is very new, although I'm one of the early investors in the app. So I've got a little bit of historical experience investing with them already.
Great. So this kind of brings us to the next step. Now, in the process of this series, we're obviously going to be giving a monthly look to the audience on where we're investing, what we're investing, why we're doing that. Chris L is going to test some of those theories and tell us if we're completely wrong in some places and generally setting us straight. Let's look a little bit, and I will say as well, we're going to come a little bit later to what are actually Chris T and my plans for what we're investing in on the Stratify app and how we're going to launch that. Let's look a little bit about the big picture though. Where we are today is, I think it's safe to say there's a lot going on. Chris L, it's 2026, geopolitical concerns, etc. What is going on out there in the world, and how is that feeding back through markets?
Yeah, it was an interesting one. Was sort of going on air today on Tuesday. The US market hasn't yet opened, and they've just come off from a holiday. So there's been interesting announcements coming out of America, which is not atypical for them over the last couple of years, but it is potentially spooking markets a little bit. Although looking at things at the moment, markets have tips are down maybe 1 to 2%, but nothing catastrophic. So markets have had a fairly calm reaction to what are, potentially consequential events. But I think there's a bit of a general reaction that the US government is again posturing with regards to its stance to Greenland and potential tariffs over certain European countries, and the Europeans obviously taking sort of probably a more firmer stance than they were perhaps initially, or at least the UK government perhaps, compared to where they were April last year when the US government started announcing its raft of tariffs across the globe to various countries. So this, you might look at this as sort of tariff 2.0, but it's very much a 1.01 or something like that. It seems smaller scale at the moment anyway. As you say, geopolitical events seem to be broad in the news at the moment, but one thing I would temper is that they are always not too far away in the background. So if you think back any kind of year, there's very rarely a year where geopolitics isn't having some major impact in the markets.
Yeah. I think that's a really interesting point. It feels sometimes this kind of news and major events can feel quite shocking and surprising when they're happening. But actually there are sort of relative precedents even in the pretty recent past with what's happening at the moment. There's also an important point here about investing more broadly as well, isn't there? And we're very much advocates here of long-term investing rather than looking at this through the lens of, well, we need to just chop and change on a daily, weekly basis. And that's going to form the basis of what we're doing is making a plan that we think is going to hold up over a decent amount of time and whether we have to work within that. So do you think there's an element here of, well, investors might just actually shrug a lot of this off and just keep going because some of the fundamentals are still the same? Do you think we could see some, not necessarily history repeating itself in markets this year compared to last year, but perhaps a bit of rhyming perhaps going on in certain areas?
Yeah, I think there's a couple of things at play at the moment in markets. There's plenty of sort of, I'll say a healthy amount of fear. I don't like too much exuberance in the markets because even though the results of markets, particularly non-US markets last year, were very strong, almost sort of unnervingly strong, but as long as there's a good dose of fear in the markets, that sort of gives me confidence that we're not kind of getting too carried away with where things are going. So that makes me a little bit more relaxed about this year and what could happen.
They've been hitting all-time highs, haven't they, Chris? This is the thing. I've been somewhat baffled. I mean, I've been looking at my pension and my children's junior ISA and thinking, well, happy days. And then you think of all the kind of economic uncertainty that's out there and the pain that certainly here in the UK, a lot of people are feeling with, ticking up unemployment and interest rates being a little bit too high and inflation still being sticky and that being kind of repeated in many places around the world. And yet you look at the investment market, it's like shrugging all of that off and going off at a pace. And that's been great. But also part of me has been like, well, when does this slow down? Or when does this potentially take a little bit of reversion back to what I would describe as normality as a complete novice investor who probably will learn more from what you say and then what we do over the next few months?
Yeah, I mean, I think a lot is made of all-time highs because it's a new high number and it gets all a bit exciting. But we should also bear in mind that markets are kind of designed by their nature to keep reaching all-time highs. That is the very essence of those investments, is that they keep growing their earnings and they're growing their dividends over time. And therefore, those investments, as they're growing, should be worth more money. And therefore, that is reflected in the stock market sort of across the globe, sort of mostly hitting sort of all-time highs. So, year by year, you will often see all-time high. Just because you reach one shouldn't be a signal to, we need to sell now because we're at the peak. Because the chances are that actually it's going to keep on going up. There will be a drop at some point in the future, but you don't know exactly when that drop is or how big it's going to be. And if you wait it out of the market and wait for that drop to come, that might still be at a higher point than where you're at now. So
I think this brings us nicely to actually bringing the kind of Stratify element in here a little bit, because the way the investments work through Stratify is a little bit different and there are some, let's call it's mathematical modeling, quantitative based modeling that feeds into Stratify's platform, which I think is really interesting, and perhaps it will have a bit of an impact on the decision making that might otherwise not happen with just a straight index fund. So Chris, just give us a bit of an overview of what is the proposition, let's call it, on Stratify in that sense.
Yeah, so I mean, Stratify is there to really be your app as an investor. We're not here to sort of dictate exactly how you should invest. The strategies that you can create in Stratify are, for all intents and purposes, really your own strategies, to be your own holdings, and you can kind of mix and match with some of your own ideas as well as some of the strategies that you can kind of create within the platform. So I think it's pretty unique in the platform space, possibly globally, but certainly in the UK, where we're not just a platform to invest your assets into general investment accounts or ISAs and things like that, and buy particular holdings. We're there to do, a couple of things and enable you to be more like like an institutional investment manager, but kind of bringing it back to the everyday man and being able to give tools and doing things like backtests, which would be something I know the typical investor will not necessarily have done much of unless they are particularly quantitative themselves. And I think often enough, investors are generally just quite bad at understanding their own performance or the general performance of how they're doing against either the market or historically. They kind of know whether the money's going up or down, but in terms of benchmarking and all that kind of thing, it's a bit of a sort of enigma to the typical investor. So here on a platform, we're kind of bringing tools where, when you're starting a strategy, you can select what sector you want in the market, set different exclusions or inclusions, however you want to set it up. And then you can run different types of strategies. So you can kind of, if you're relatively experienced on a platform investing in ETFs, these are kind of different strategies. Might be your own sort of personal ETF, if you like. It's not strictly fun. You do own the underlying holdings, but it might be some sort of thematic strategy. So like the flagship strategy on the platform is a momentum-based strategy, which will invest in stocks that have really good momentum. So that's sort of stock price performance over the last 6 months as a rule of thumb is kind of like the strongest out of its peers in the market. And with the platform, you can kind of run this through a little back test and see how it performs over different time periods. So 1, 3, 5, 10 years, and then compare that to the index and go, okay, well, I can see how and when that's performed, get a feeling of why it's performing, perhaps how it is, and when to expect those drops or rises, and you kind of get a feel for what it might look like going forward. And with that, I think you can build some reassurance that what you're investing in is hopefully something fairly solid. There's some good scientific background behind what you're investing in. Just gives you, the options and the tools that you need to sort of make better decisions effectively.
So is that a tool that many large investment houses will be using then, Chris? So you bring in that, like you said, you're bringing that to the retail investor, that kind of quant approach.
Yeah, I mean, it's very much on the institutional side where, I mean, even on, retail, private wealth management and stuff, quantitative techniques are something that is pretty much eluded the entire industry. Skills is something really only reserved for the institutional investors and big, large investment houses. Plenty of fundamental investors who are looking at individual stocks and the characteristics. I think Daniel's been on the podcast before and just described between the two, but quantitative is looking at sets of parameters and characteristics of different holdings and trying to systematically weigh up how their performance is being formed. So Stratify's got its own unique algorithms that are used to set up these strategies and create your own portfolios.
Yeah, there's a couple more in there. So we have the momentum based, and then we've also got moving averages, and then there's MACD as well. Is it in there? Just give us a quick outline of those two.
Yeah, MACD. Yeah, it's nothing to do with some McDonald's or anything like that. It is moving average convergence divergence. So these are the kind of first three strategies that Stratify started with, and the plan is to keep rolling out more strategies. And this is where we'll welcome even our users to come in and give us more ideas of how these things are. But all three of those are different types of momentum based strategies. Moving averages is kind of how it says it's like when it could be a 30-day and a 200-day moving average, and so the stock price movements over two certain time periods, and when they start crossing over, it creates like a buy signal or a sell signal. Traders often use these in portfolios to sort of work out when the best time is to buy. This kind of automates this within a strategy for customers effectively.
So we wouldn't have to worry about that. That would sort of calculate that for us. Is that fair?
Yes, exactly. So the algorithm's there working away in the background to basically create the portfolio for you. And every month, the algorithm will keep rerunning and work out whether those signals are still strong or not, whether there should be a buy or a sell against those stocks. And so it will trade the portfolio accordingly if it needs to move into something that's got better signals effectively.
I mean, for me, I find it very compelling because, like you say, it would be straightforward enough to just put things in an ETF. But actually, if you can access some of these pretty sophisticated tools in an individual at an individual level, then it gives you something different, right? And as Chris mentioned, he's got his pension, I've got a pension, and I have mostly just got that in an index fund. But actually, now I want to invest beyond that. And I want to do something slightly different. I want to differentiate my investing approach a little bit. And actually, that kind of Stratify offering for me is pretty compelling because it is doing something slightly different that I don't have access to on my traditional broker who's just selling me an index fund or an ETF.
And if I'm honest, I'd be hugely intimidated by if I did try and do that myself, or wouldn't be able to do it, Chris. So
well, it's not practical to do it yourself, right?
Yeah, exactly.
So I think that's what's quite interesting.
Yeah. I mean, there's nothing wrong with index funds. Let's put it out there. I mean,
no, to be fair,
to be honest, the starting place for every investor, if they're trying to go it alone, is starting with a fairly broad-based sort of index fund, whether it's ETFs or mutual funds, and keep it low cost and simple. Not try to overcomplicate things, particularly if you don't want to spend lots of time doing it. And I think the more kind of energy you want to put into it, you can get a bit more. Do a few more exciting things, but the Stratify app's really good at that because I think it can make it more interesting and a bit more engaging. That's kind of half the purpose really of the app, is to really engage you into becoming your own sort of quasi-professional kind of investor. Not saying it's going to turn everyone into a genius overnight, but hopefully the results will start speaking for themselves quite quickly and for users as they're using them. I mean, personally, I've had 10 months of performance history on my first strategies. So I set up a high-risk momentum strategy and a low-risk momentum strategy. Just as a nice. I mean, I'm mostly a high-risk investor personally. I'd say everyone should fit into that box. I wanted to sort of compare the difference between it. And low risk doesn't necessarily mean low risk by everybody's standards. The low-risk portfolio has done around 30% over the last 10 months. So a lot of people probably say that's not that low risk. Well, I mean, yeah, because it's still outperforming the FTSE 100 since I've had it by a good 13% or so. And the high risk, of course, well, that is high risk because I've so far achieved 64% returns in that. The algorithms have achieved on my behalf pretty strong returns.
Yes. So look, this is a good point at which to say. Obviously, the past performance of these things is not going to dictate future returns, and if you do invest that way, your capital's at risk. I think what this brings us nicely to though now, and I know that people probably following along probably want to hear what it is Chris T and I are actually going to be doing with our money on the platform. Now, neither of us has actually hit the invest button yet, so we're not live on our portfolios. We have, however, made preparations for what our kind of top line choices are going to be, and the next step will be for those who want to kind of follow along and engage with what we're getting up to. In subsequent episodes, we'll be coming back to our initial decision was and looking at changes that have gone through in the portfolio and just generally keeping up to date with how things are going. So who wants to go first? Chris T, do you want to lay out where you've set your stall?
I can. Yeah, why not? So we've agreed 500 quid we put in, and we are looking at a 5-year horizon, right, Ed? That's kind of where we've set our stall out, as you rightly point out. I have decided to look at a few sectors, and I think that's what I've excluded is probably the bigger question. So you go through a bit of a training session on the app, and then it's like, well, what kind of sectors do you want to be involved in? And I have gone for business services. So the reason that I've added that in as something that I'd like to explore within the portfolio or firms within that is that I think that there's going to be a massive retraining of the global workforce with sort of changes in the way that we're working with AI and other bits and pieces involved in that. I think there's going to be a change in the way that we structure our economies and the way that we deliver services. I think there's potential for a big growth in that in the next kind of 5 years, particularly around this retraining and workforce development piece. And then on the IT services, as we try and build kind of infrastructure to accommodate for that as businesses bring that through. So I've gone for that. I've then added in consumer goods just because I think, people are always going to buy stuff, and consumer firms are pretty good at bringing that up and kind of finding the right things that tap into our wants and our needs. And judging by the amount of Amazon packages that turn up at my house every single day, I don't think that's going to be going anywhere. So that's a big one for me.
Okay. I'm Chris L. Feel free to interject here and tell me I'm wrong. I'm slightly bearish on consumer goods, and I'm bearish on it because of all these new weight loss medication treatments and things that have hit the markets. And
you're worried about the Greg share price head, is that it?
That is exactly what I'm worried about, Chris. I don't know if I might be in the wrong category here, but yeah, no, genuinely. I mean, Chris L., have you seen anything around that? It's definitely having an effect on the economy.
Yeah, I mean, if you think about all the talk, with food suppliers particularly, and the talk of, ultra processed foods basically being engineered by the food companies to try and effectively sell more products. These would be almost in your sort of consumer staple type corners where they're generally fairly impervious to sort of downward trends and slow and steady sales, but never go down too much. Yeah, it is an interesting one. How will the shares of those companies be affected? We're always going to need food of some sort, but yeah, does that mean there's going to be a small slowdown in sales because people are actually eating less? Maybe it'll impact some of those kind of companies. But I mean, on the consumer side, I actually think there's potentially, on Chris T's talk of AI plays, I think, speak personally, but I do wonder if brands are going to have quite a good comeback in the next few years in their shares. So if you think about what is AI going to do to a lot of, we're going to still keep spending money, but at the same time, we're going to buy what we trust and what we know and love. But at the same time, those brands are going to be able to lower the costs of how they do everything, and they're going to keep opening up margins and make even higher profits potentially. AI will, I should think, drive profits higher for a lot of companies if it can bring about a lot of change. If it does change the workforce significantly over the coming years. I think we're yet to see that in the global economy, although sort of murmurings in the US, we're already kind of seeing it. And UK unemployment figures are sort of gradually moving up. Are we seeing an element of that? And then again, how does that then impact consumer behavior if there is going to be a period of destabilization in the marketplace? People are losing their jobs. Then at the same time, whilst there are going to be the haves that can keep spending on their brands, but then there are going to be a lot of people that suddenly don't have incomes from jobs anymore because they're struggling to find one in a new environment where there's going to be a whole need for retooling and retraining of people in workplaces.
Right, Christy, let's keep going. Let's keep looking at which sectors you've picked here. What else have you got?
Yeah, no problem. So the other one I've got in there is energy. I think if you follow the news and you've seen what's been happening in Venezuela and other places around the world, and and on that AI piece, energy is a massive part of that, the infrastructure that makes all of that kind of work. I have to say, I'm not massively as bullish on AI as perhaps many others are. And we'll come to that, Ed, when we start talking about tech stocks and their valuation, which I think you've got in your portfolios. But I think energy just generally is always a crucial concern. Economies run on energy. I think you can see a lot of the geopolitical machinations around that are looking to secure energy security. And there's been talk about that in the UK and things like that as well. So I just think it's a sector that's going to be ripe for kind of investment at a governmental level and change around that. And so, yeah, energy is always going to be kind of a key driver to any of this change. And so I've got to have it in my portfolio, I think.
I'm kind of on the other end of that with energy. I think
Really?
I see a world with the oil price being low because it's good for the right people. I see a lot of the kind of the green energy and stuff like that. A lot of those investments starting to look a bit sour. I'm a bit turned off by the whole. If the oil price were to start doing something different, I think I'd probably be more interested in it. But personally, right now, I'm not going to take a stake in it. Actually,
We'll see how that plays out.
Sal, do you have a view on that?
Yeah, I mean, it is interesting. I mean, both. This is the great thing about investing. everyone can have an opinion and both sides can be kind of right or wrong at the same time.
We're both wrong.
Energy prices have been under pressure for some time. Oil has been on a bit of a downward trend in the last couple of years. Oil and gas majors haven't necessarily done that well, although, the last 6 months actually, BP and Shell, they have kind of held up, in the UK, despite where the oil price being where it is. In the short term, the US has been a major player in terms of coming to the market with huge amounts of new sort of volume to the market and reserves that they've got. And yes, there are pressures on Russia not having quite so much capacity as they did, flooding the sort of eastern market. It's a global market, so oil price depends on who's buying what, where, and everywhere, really. And then Venezuela at the moment, they haven't been part of the energy and supply chain really that much because of sanctions and all the rest of it. But if they can, does that open up more supply potentially in the future?
Yeah.
There's plenty of ways to go. And then the other argument is still the green argument. Electric cars are going to keep taking over. They certainly are in Europe and China, perhaps less so at the moment in the US, a little bit slower in the uptake there. But if, again, autonomous vehicles start taking over, they have to be electric to be viable and for the economics to work properly there. That will possibly displace more gas cars than, sounding very American there, as old petrol cars, depending on which continent you're sat on listening to this. But, that could drive down oil prices more than is currently being predicted. I would actually sit more negatively in long term on oil, although I think short term certainly could continue with some momentum. Does form a part of strategies because there are good signals on it at the moment. But yeah, long term I'd be slightly bearish on them.
Chris T, let's finish off your portfolio then. What have you got?
Okay, so the other thing I've got is finance. Maybe it's biased because of the sector that I work in. I just think as the world kind of changes and as things get a bit more complicated with maybe global markets changing slightly, I think people are going to be relying more on financial services and guidance in order to try and navigate all of that. I don't know. I think we might see a bit of a resurgence of some of the brands that we're used to on the high street as well in other ways, and people are going to wanting to make more of their money, and I just think there's potentially some opportunity there. Industrials is another big one. So this is kind of a bigger thing, and this kind of speaks more to kind of geopolitics, and maybe I have a slightly controversial view on this as well, being a sort of bleeding heart centre left bloke. But I imagine within industrials includes sort of hardware, including defence spending. Chris, is that included within there, or
there should be a defence sector? Industrials would be more looking at your capital goods type of thing. So think sort of diggers and
right, yeah, okay,
heavy machinery.
I picked industrials as well because I know the world needs more diggers. But I think we're going to have to find you the. I think we're going to have to find you the defence sector as well. Why is that, Chris? You're doing a sort of a centre left pitch for the defence industry.
Well, I just think we've reached a stage of sort of global uncertainty, right? And Europe has said overtly that it needs to increase its defence spending in light of global threats from all over the world. So I think I see that there's going to be money pouring into that, and that I think that there will just be a massive investment in that. And so I think there could potentially be an upside on that. Now, previously, from an ethical standpoint, if you looked at my sort of pension portfolio and others, I would have steered clear. But I think my position has changed on that slightly, in that if you want to preserve the way of life that we've got in our democracies, and there are these kind of existential threats emerging all over the world, then we need to be in a position to be able to do that. And so that slightly changes my stance on that, away from, oh God, no, I wouldn't want to invest in anything that could potentially cause harm to anyone else, to, well, actually, if there's a threat out there, then we do need to respond to it. And so, again, there's been a lot of signals that this is an area of focus for many European governments as well as other areas around the world. So as things get more uncertain, sadly, it becomes more important, and I've got less ethical concerns about it. And actually, the flip side to it turns to, I think those ethical concerns are actually about preserving values that I see as important in the light of threats from slightly more autocratic regimes.
Hard-edged investment realpolitik. I love it, Chris. I think it's a fantastic strategy. I'm very, 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 very refreshing. Yeah, and refreshing to hear that in 2026.
Well, we've got to live in a real world, haven't we? So there is a part of that, and it's quite interesting, that change. Like, as I said, 5 years ago, I wouldn't have thought about that at all, but now I do think the next 5 years that's going to be a big thing. And on the industrials thing, look, there's infrastructure that needs to be invested in certain regions as well. Europe, again, again. We need to, and there's a lot of reshoring as well. There's talk of that. This is a double-edged sword. Maybe it's an attempt for me to hedge it within the portfolio. But if global trade has more friction, then you're going to end up with more people investing in what they've got at home and having to make things again, rather than being a service economy. And so industrials, I think, forms part of that. Countries may be trying to scale up their industrial capabilities quite quickly as well in order to respond to that need. So I do see that there being an opportunity there potentially.
Okay, so I'm going to lay out. So I've got a few similar choices to you in my portfolio. I've got industrials like you, like I said. I think we've also both got utilities as well. I personally like utilities when I think about things like, well, the water industry is probably a bad example in the UK as far as the
burst water main outside my window would suggest there's some work to be done there, Ed. I don't know whether that's
almost certainly, yeah. But I think in other areas, utilities generally are quite. Things like quite inflation resistant in terms of income and that sort of stuff. I think Chris will tell me if I'm wrong there, but everybody needs utilities, right? So they're quite resilient.
Yeah, generally that's how utility stocks are kind of thought of. I mean, it's an interesting area. Is it the end utility you mean though, or is it partly in the generation side for electricity? So you kind of got your various different types of utility, but then you've also got generation, which can sort of start to fit in between the energy sector and utility sector.
Interesting. So the big differentiators I've got with Chris T's portfolio, I've got healthcare. So that goes back to my thing about the weight loss jabs and stuff like that. I think we're in pretty revolutionary times in the healthcare industry. I think I've read stuff about brand new tailored vaccines and stuff for illnesses. There's a lot of really interesting stuff. It's a spicy sector generally. The gains and the losses are quite big. So I think you need a bit more nerve to be in healthcare, but it's pretty. There's always interesting stuff going there, I think, and I've got a pretty tolerant to high levels of risk as well. So I'm kind of in on healthcare. What else have I got? I've got my favorite here, Chris T, you'll know and love, is non-energy materials, which it was in specific when I picked it, but I'm hoping that's going to give me a gold play.
I mean, they'll come into it. It's not necessarily, I mean, gold miners, I mean, they've had a fantastic year, particularly like the last 6 months where their share prices really started to catch up with the 3-year bull run on last year for gold miners, but yeah, 3-year bull run now for gold, and yeah, some of those miners are really starting to gain some momentum. So they have come into portfolios, that's for sure. It's worth mentioning. I mean, on my portfolio that I've been running, I was completely sector agnostic. I just let the algorithm do its thing and run away with it. So you can definitely exert your own influences over which sectors you want it to pick, or you could just say, I want you to have the widest universe and trust in the algorithm and see. If you want to know what it's kind of been investing in the last year, then I can kind of give you a pointer as to what has been good and where it's the typical sectors at the moment and actually the banks have been probably the strongest sector over the last year. And the signals were to buy it sort of this time last year. They're still signaling to buy it this year across both the sort of low risk and the high risk portfolios. They've had a really good year, sort of typically 50 to 80% returns on some of those UK banks.
Wow.
So my challenge to that, and I've not put financials in my portfolio. So my challenge to that for banks is interest rates are falling, right? We have a situation where pressure is being applied to central banks to bring interest rates down. Would that not have a negative impact on their earnings in the year ahead?
It might be a bit too soon to start hitting the earnings yet for the banks. They've basically been in a very compressed position for years. So they're kind of forgotten shares that have been waiting for their moment to shine, and then once interest rates started to rise, they could suddenly open up their margins. You know, the difference basically between what they can lend at and what they can offer depositors, which is basically as often as they can zero. Yeah, they've had now a good couple of years where they've really managed to open up their margins, and you do have to wonder how well they're going to be able to keep those margins opened up as interest rates come down. The quicker they come down, I think, like I say, banks will start to struggle. But at the same time, you know, if you look at the sort of fundamentals, still go, well, you know, they've been increasing their earnings, still forecast earnings growth, and they're still trading at good price earnings multiples on what they've got. So can this potentially continue? Our signals at the moment still favouring some of those banks. So I don't disagree with you at all, Ed, but there could still be some life in the bank story yet.
Yeah,
I'm
look,
hoping,
it's all
I'm hoping
kind of,
so, Chris. I'm hoping so.
it's all
Yeah.
part of the rich mix, isn't it?
Again, it's probably personally, as a taking my sort of Stratify hat off for a second. Personally, do I believe the banks in 10 years' time will be the best investments? Maybe not, but at the moment, yeah, they're still pretty.
Yeah. So I've saved the last differentiator between my portfolio and Chris T's portfolio for last, and that is because it's perhaps the most controversial. Because I think everybody's probably got an opinion on it who's interested, and that is tech. I am holding tech, and Chris is not holding tech. Now, we'll say, I'll say to those of you watching or listening, we could have done like Chris L suggested, and just set the strategies and not go into too much detail and let the strategies do their work. We did want to do a bit of differentiation between Chris T and I. That's why we've gone into a bit more detail like this, because we want to test our own theses against each other. So I'm in tech
and prove mine to be correct. That is ultimately where we're going to.
Okay, all right. We'll talk about what the back testing did for both of us in a second, Chris. So let's not get too excited. Yeah.
Past performance. What did you say about past performance?
Past performance.
There we go.
Yeah. So look, I'm in tech because everybody's in tech, and I don't think it's going away. I also, if I start to put a tinfoil hat on, I also think
one of many that he's got back there.
Yeah, I've got a whole collection. I also think it's now getting to the point where some of it's becoming a bit too big to fail. We're a bit like, banking crisis big sort of stuff. I don't know if that's a wild assertion to make, but you almost feel like there's so much feeding into such a small selection of big stocks. And actually, some of the market concentration, I also think is probably a little bit, the risks of that perhaps a little bit overstated sometimes. My one big signal, I think I would say, that would maybe send me out of tech would be if someone like an OpenAI were to do an IPO, announce an IPO, I think I might step out at that point, because that almost signals like a top to me. I don't know. I'm taking some pretty wild assertions here.
So my thing here is that I think they're all massively overvalued. The Mag 7, and they've been driving a lot of the US. And I've been watching that slightly nervously, going, when does this big correction happen? And been doing a bit of digging on that and looking at the sort of the fundamentals around Nvidia and how they're sort of funding that business and where their customers are coming through. And there's an argument that there's a circularity there of them investing in firms who are then spending that money back with them, which means that the balance sheets that they've got can't necessarily be relied upon. And it does start to remind me of, and I am old enough to remember this, the subprime crisis a wee bit, where you had sort of people with kind of valuations that were somewhat divorced from reality. And then what you end up with is loads of people build industry around that. And then eventually everyone realizes the emperor's wearing no clothes, that these valuations aren't correct. And you get a contagion through it, which leads to a massive wobble. Now, I take your point on the likes of Google and others where, they are probably too big to fail. And they said that about some of the banks, right? And Lehman Brothers suggest that maybe they aren't all too big to fail, although, the bailout did come. The other concern I have...
You just let the first one go, and then you save the rest of them afterwards.
Okay, well, that still caused quite the wobble and created some issues at the time. And the other thing I'll say is I think AI might be a bit overhyped. And this is a narrative that's starting to come in. I'm seeing it in a lot of different places. So this isn't mine, but it's like, okay, well, it's a slightly better Google search engine or more, but some of the things that they've been promising us that it will do, admittedly, it's still relatively early days, haven't materialized. So I know that slightly contradicts what I said previously about retraining the workforce and stuff like that. I think there is going to be, obviously, massive tech disruption and change in the next few years, and that's going to lead to people changing the way they need to work and us having to retrain to a certain degree but the ambitions that they seem to be setting alongside, I just don't think will necessarily get there. And at the moment, when you think about the kind of GPUs and the power that's being used to create this, it doesn't add up. It's like a money burning machine. You have to invest in these hugely powerful, expensive GPUs, and what you end up with is something that's Google plus plus plus. So what we might end up with is kind of a bit of a retrenchment back, whereas, well, actually, those are a bit too ambitious. They're uneconomic, and so we are going to create something that you guys can use, that's going to change, that's going to be great, and all those kind of good things, but also perhaps doesn't deliver what everyone thought it would, which is we're all never going to have to work again and we can all sit at home living on universal basic income. I just don't see it happening. So I think the hype train might come off. I think that might have an impact. I've mentioned before about that kind of overvaluation, the circularity of it. It just makes me nervous. And so if I were looking at, a 20-year play, it would be in there. Even a 10-year play, it would be in there. But 5 years, I think there could be a shakeout. There we go, Ed. So you're wrong.
All right. All right. Look, I think so. The thing for me as well is I also think that when we get into this stuff about things are overvalued, it's not going to do, and we're all looking for the next crash, we're all looking for the bear market, and everyone thinks, it's AI is going to cause it. Generally speaking, I'd say the bear markets that happen is usually the things that nobody ever saw coming. I mean, think about COVID and this sort of thing. Okay, dot-com bubble is perhaps one that people saw coming and predicted correctly, but financial crisis, COVID, those times of serious market stress, they tend to come out of clear blue sky almost. And it's kind of, I don't want to go against, again, that's my sense of it. Chris L, what do you think? Do you think we're both barking up the wrong tree here, or are we both?
Or barking mad?
I mean, you say the dot-com bubble, people guessed correctly. Well, there were plenty that didn't. That's how the bubble formed, because they were all bidding on the way up. They just couldn't miss out on the latest, the greatest, next best thing that was going to solve every problem forever. And that's what it kind of proved out. Like what Chris T was saying, if it doesn't, AI doesn't do more than just Google ++, is it going to be .com 2.0? There's a lot in the tech world promising that 2026 is going to be the year that everything changes. So we'll see if 2026 materializes as it is. I think the Uber bulls of the tech world will kind of say it's already happened. Like you and I, we don't necessarily see it in the data world. At the moment, you can't use one of those and go, oh yeah, it can just do all my work for me. They are becoming more agentic, and that sort of word is the sort of, forgive the sort of industry buzzword, but it's that ability for the AI model to step out of its model zone and start performing tasks in something other than its own native program, which is becoming more of a thing. But it's that ability to sort of, can it just, all the various different applications we start using in our offices, and every organization's got their own massive suite of different programs and stuff that don't talk to each other, that you have to kind of start rekeying data. Will that all go away soon? Possibly. Organizations haven't systematically changed themselves yet, but I, for one, am just hoping for God, simplify some of the admin data at least.
Part of it comes down to, and I know, Chris T, you love a narrative. Part of it comes down to how much can the tech bros just keep the narrative rolling forward, right? And how much can they keep everybody loves
I think the other new narrative is the physical AI, which we haven't sort of touched on, which is coming into the real world in the form of some sort of machine, whether it comes through the car and autonomous driverless taxis and delivery machines, or sort of humanoid style robots, which are now becoming much more prevalent. This is something that was
I'm not having one in my house, Chris. Sorry, I'm sorry to cut. I'm not having one in my house. So again, do you see me as an indicator? No chance.
I'll give it my data. I'll have one in my house all day long. Just do all my dishes, do all the cleaning, do the cooking, put the kids to bed. That would be even more helpful.
Oh my God, terrifying. No. My poor daughter.
No, I'll keep that bit for myself actually. But yeah, so yeah, it's there are two sides to all of these things. If even half of what they say comes true, then these tech stocks and others that we don't yet know of will have big parts to play in markets coming. And another thing that's quite exciting, the private market space, I think, is SpaceX. Interestingly, on the sort of hardware side, we're talking about building infrastructure. Well, building infrastructure in space and AI data centers going to space is the next thing that everyone this year has been talking about in the tech world. Are they all trying to pull the wool over our eyes? I'm not quite sure.
I mean, yet another tech guru telling us they're going to destroy space as well as. And sorry, I'm getting really on my. But no, I'm all right. I don't want to be involved in that either. So
the centre left is coming out, and you could see.
Yeah, there you go. I can't. No thanks. I'm not going to invest in. Sorry, I'm dominating thing here. No, I might be wrong. What you say is very true, Chris, in terms of that. But I just think there's a bump in the road here that perhaps is being completely ignored, and we've been prostrating ourselves at the feet of tech gurus for a long time now, saying you're going to change our lives and for the better. And I'm like, I'm not sure it's happened at the same pace as what they're suggesting. So I don't know.
Yeah, I don't even know they definitely say for the better. Change our lives is it's debatable whether it's for the better or not, but.
Yeah. Look, James, I think we've gone into some pretty good detail here. I think we need to put some scores on the doors between Chris T's and mine's kind of opening projections. And then I think we're going to have to go away and apply our knowledge. So,
well, hang on a second, Ed. So I'm doing momentum, right?
You're doing momentum.
And you're doing, and what's your
And I am doing moving averages because I once read an article about moving averages and I thought it sounded quite good.
That's good a reason as any. The other thing to mention is I'm keeping mine in a GIA, right? A general investment account.
Yeah, that is right.
And you're going into an ISA. Do you want to talk about that? Why?
Well, I mean, I'm in an ISA because I currently, I'm happy to do so. I'm not filling up my ISA elsewhere. So that's kind of fine for me. And it means I don't have to worry about the tax, which is quite nice. You have your own reasons for picking a GIA, though.
Yeah, I think it's just, first of all, it's good to see how the two things rank alongside each other, but also, there's stocks and shares ISAs knocking around in the background for me, and there's rules changes happening there. So to keep life simple, although I'll have to look out for the capital gains, as you said, there might be something on that. But that's a conversation we can have as we go through. I
think it creates an interesting differentiator because there will be considerations for you around capital gains and that kind of thing. We'll see how we go. It will possibly colour some of your investments. But again, this is something we're going to learn on the journey.
100%.
You should be fairly safe on capital gains with a £500 investment.
Yeah, right? I know. Yeah,
you do have a £1,000 allowance, and if we breach that for you, then then I think you can.
Don't need to worry.
I'll happily pay the tax.
Yeah.
Centre left coming out again, Chris. There we go.
Right, so let's do it. Let's scores on the doors. Chris Tuite, I know you've been avoiding it now for an entire hour, but I'm going to get you to answer the question now. What was the 5-year projection on your initial decisions? These are all subject to change as well, because I don't think these are set in stone. But what did you get?
Absolutely. So my projection was £500 as initial investment. We haven't added in any monthly contributions onto that, which would make a significant difference, it's worth saying. Mm-hmm. So we're just seeing how we can turn that £500 into something as much as possible over that 5-year period. My 5-year projection was that it would become £937. Now, probably more important than that is the percentage growth on that. So if anyone sat here is thinking about doing it themselves, based on past performance, and again, past performance, it even says here on the thing, it does not guarantee future performance, but you're looking at about 87.5%. Return over that 5 years based on sort of the different criteria that I've fed into the Stratify quant algorithm. So, yeah,
it's interesting, Chris. Mine came back with £945 and an 89% over 5 years.
So you don't need tech stocks. That's the thing here.
Don't need tech stocks. Things are very close. I think we have set up here for a very interesting. I don't want to call it a contest, because it's just two guys investing, not turning it into a competition.
Hey, we're here to help each other, right? That's it.
We're here to talk about it and help each other out, and not lord it over each other on a monthly basis.
There might be, when we come to the end of the process, a little bit of gloating from one side or the other, but we can't confirm or deny that.
A small amount of lording, perhaps. Right. With that, I think we have potentially reached the concluding thoughts. I will say at this point, if you've stayed with us for this long, and brilliant. Please do ensure you subscribe to the channels, be that on YouTube, Spotify, or Apple, to follow us on our journey. And we want you to be involved as well. So please do let us know your thoughts on some of our investing decisions and our theses. We're very keen to hear about that. And yeah, we're very, very excited to be on this journey in partnership with Stratify, because we are, doing something new and different, and I think it's going to be really fun and really interesting. So with that, Chris L, thank you very much for joining us. We look forward to having you back next month when we've actually launched our strategies. And Chris T, thank you for being my foil in the journey, and hopefully we shall have some interesting results in the months ahead.
Likewise.
Yeah, thank you very much for having me, and look forward to seeing you in the next one.
Yeah. So with that, thank you everybody. We shall hopefully see you again very soon. So I shall say goodbye. Thank you, everybody, and goodbye. Don't forget to subscribe to the show on Spotify, Apple Podcast, or YouTube. You can also follow all our latest updates on TikTok, Instagram, or X. Finally, check out all our money stories on the Mouthy Money website and subscribe to our weekly newsletter for all the latest straight to your inbox. Thank you, and goodbye.